While Professor Morisi has fingered China as central to the US's woes, China itself must be alarmed by recent events, not the least because it holds $1 trillion or so of downgraded US debt. I spoke to JP Morgan's chief Chinese economist, Jing Ulrich, about the impact of the global turmoil. Well, Jing Ulrich, the US economy is clearly slowing down now. What are the implications for China of that?
The US economy is slowing down, so is the European economy. Remember, China is the single largest exporter in the world. Europe accounts for about 22% of Chinese exports. The US accounts for about 18%. So the two markets are very important to Chinese exports. Importantly, on the positive side, emerging markets have become a lot more important in the last 5 to 6 years. Emerging markets now account for over 20% of total Chinese exports. So going forward, as the European economy and the US economy slow down, China has to increasingly look to the emerging markets to export its goods to. And secondly, clearly China needs to focus on domestic consumption. So in the coming few months, we would expect a lot more pro-domestic consumption policies to be announced by the Chinese government to try and offset the slowdown of the economy in Europe and in the United States.
Well, at the same time, inflation this week was shown to be 6.5%. Do you think that that's going to be more of a problem in future, or do you think inflation has now peaked?
There's still underlying inflationary pressure because of rising wages, because of the monetary expansion we saw in the last 2 years. However, in the near term, we think we should begin to see headline inflation figures beginning to moderate. And that is giving the Chinese government some leeway in terms of the possibility of easing monetary policy if the external environment remains challenging going forward.
Well, what do you think is the outlook for Australian resource exports to China now?
China's demand growth will remain very strong for the time being. However, in the medium term, we do expect the growth rate of China's demand to slow down. But we need to keep in mind, in the 5 years between 2011 and 2015, China still has a lot of infrastructure programs underway as part of the 5-year plan. Even though growth rates of China's demand will slow, the actual quantity of demand from China will still remain very strong, really helping support the overall Australian economy.
How do you think China will respond to the downgrading of America's credit rating?
China has $3.2 trillion of reserves. The country is the single largest foreign holder of US dollar treasuries, about $1.2 trillion. In addition, of course, China holds a lot of corporate bonds as well as agency bonds in America. So the recent downgrade, of course, is a concern for the Chinese government. Going forward, we think the Chinese government will gradually diversify its holdings of foreign exchange reserves. They may be purchasing more resources, including resources in Australia. However, we must keep in mind there are very few bond markets in the world that can absorb the sheer demand from China. So we believe China will still purchase US treasuries because every year China accumulates several $100 billion of foreign exchange reserves. They will seek to diversify at the margin, but we don't think they will sell down US treasuries, at least not for the near future.
Thanks very much for joining us, Jing Ulrich.
Okay, thank you.